All right, excellent. So today is May 27th. It's a Friday, and it happens to be the end of the best week in the market since November of 2020, believe it or not. Which doesn't change at all the theme of my meeting today, which I had set up last Friday when we had just ticked for a moment where the S&P had dropped about 20% from its all-time high, making it, by some definition, a bear market. And then, of course, we have this great week. So part of the presentation today will be, again, an overview of what we've been seeing in the market this last 6 months, why it's happening. Then I'm going to describe for you a little bit about what our strategy has been over a longer period of time, really the last 4 years, and how that compares to our strategy today. And then really finally, what it means to you and what your expectations should be of your portfolio and the market going forward. And then, of course, I will leave time at the end for questions or concerns that you might have that I can address more specifically. All right, so what has been going on? This chart you guys have seen many, many times. I've showed it really in every meeting we've had so far this year, but it gives the context to what this drop this year really means, going back about 15 years. So you can see the Great Recession, where we saw the market drop about 50%. You see several corrections along the way where the market had dropped somewhere between, the high single digits and, less than 20%. Then you see the COVID crash, right, in March of 2020, where we saw the stock market drop 32%, but then quickly recover. And so far this year, year to date, the market stands down about 15%. So based on where it is today, it's not even the worst correction we've had, over the last 15 years. But there are a lot of things right now going on that are triggering particular anxieties and fears in my clients, which is why I've been so diligent about these calls. And it's really that diligence that I kind of want to highlight. So far year to date, this will be our 4th Zoom call together. And just to kind of remind you what we've been talking about this year, our first Zoom call was on January 25th, where I was essentially saying, listen, a correction has happened, but let's take a long-term view about what this correction means in the context of the long market. The fact that these corrections happen like once every 2 years, and they're simply part of the market cycle. Then after about a month of nothing good happening, we had another Zoom call where it was like, okay, this correction might be here to stay for a little while. So if that's the case, here's how we're going to be managing your portfolio in a potential downturn. Then after that February call, it looked like maybe things were getting better, and then they didn't, right? So we had another call a few weeks ago on May 9th where I was laying out for you guys, okay, how long should you expect it to take for the stock market to recover if this is just a correction, or if it gets more severe and turns into a bear market, or if it gets more severe and turns into a recession, right? So I was kind of setting expectations for what might happen into the future. And then, of course, we come to our Zoom call today. And again, that was triggered by the fact that it looked like we might have been going from a defined correction to a defined bear market, which would need to change your expectations for recovery of your portfolio. That still may or may not be the case. Certainly 1 week does not make a trend. Okay, so let's take a little bit longer view about, again, reminding you what our strategy has been and how we have prepared for stock market drops in the past, okay? Going back all the way to about February of 2018, I had become concerned that the stock market, after 10 years of a bull market, may have gotten overvalued and we might be in for a longer or deeper recession than normal. So we started building what I had called the war chest. And many of you guys who have been with me for many years remember the war chest. For 2 years, that war chest did you no good whatsoever. And then the coronavirus crash hit. All right. And that war chest became the single most important part of our investment strategy to allow us to stay the course through the COVID crash and through the recovery. So we did active things like we did loss harvesting at the bottom of the market in March of 2020. We used defensive investments in order to provide the cash flow you needed all through the COVID crash. And then by the second quarter of 2021, we had gotten all of your portfolios back to what we called a normal allocation, okay? So we had dissolved that war chest. We had fully reinvested it back into the market, okay? But then just a few months later, in December of 2021, December of last year, I started to get nervous because the Fed was signaling that they were going to be increasing interest rates. And I got nervous about what would happen if the bonds in your portfolio, because of rising interest rates, dropped, and the stocks in your portfolio dropped because a too aggressive Fed would trigger a recession. Okay, so in December of 2021, for those of you who are in the retirement years or very close to your retirement years, we transferred a chunk of your portfolio over into structured notes. Okay, most of you guys did that. Some of you guys declined to do that, and that's fine. But that was our strategy in December of 2021, was protect some of the bond pieces of your portfolio. All right. We also committed to maintaining our international diversification and minimizing the amount of junk bonds in the portfolio. Junk bonds being the most susceptible to a downturn in the economy and higher bankruptcy rates, right? So we brought that level down considerably. So that was our strategy right up until the start of this year, okay? One thing to remember, okay, as investment advisors, as financial planners, my job is not to predict what's going to happen in the market. It's to prepare for what might happen in the market. And that's what all of those strategies have been all about. And that's what my focus is on right now. Not predicting whether this is a recession that we're going into, not predicting whether this is just going to be a correction. It's preparing for whatever the market might throw at you to make sure that you can have the cash flow that you've come to rely on without needing to worry about running out of money before the end of your life. Okay, so then what are we preparing for the next 12 months to potentially 4 years, okay? All right, this is what we're preparing for. And you guys saw this slide in the last presentation. Right now, we are still in a correction, a drop of about 10%, where we've seen a decrease in the optimism around future profit growth, but most of the economic fundamentals are still relatively good. However, we are right on the cusp between a correction and what is the next worse, a bear market. Okay, a bear market typically is a drop of about 20%. It includes pessimism or less optimism about future profits, and there's evidence of some economic problems, in the economy. And clearly that is the case. Clearly there are some economic problems. We have issues with inflation, right? We have issues with high interest rates in order to battle inflation, okay? There's still supply chain issues. There's labor dislocation issues, right? There are lots of good things though, okay? And we'll get to some of those good things. The next worst step beyond a bear market would be a recession, okay, where there is significant pessimism about future profits and there are significant economic problems. We are definitely not there yet, though a lot of news outlets have been touting that a recession is coming, I still do not think that is the case, and we are not there yet, though we are preparing for if it does become the case. And again, like I said last time, if we can't be on the same page about the fact that this is not the end of capitalism as we know it, and businesses will no longer be able to take raw materials and employment and put them together to create profits, if we can't be on the same page about that, there's really nothing more for us to talk about. Okay, so what is our cash flow strategy if this situation deteriorates? If we do go from correction to bear market to recession? Well, we essentially have about a 5-year plan for providing you the cash flow that you either currently need or will need in the next few years from your portfolio. And this is the plan, okay? This pie chart does not represent an actual allocation, all right? These are just different pieces of your portfolio. You've got the stocks and the bonds, you've got a little bit of cash in your portfolio, you have a natural resources investment, a real estate investment, and structured notes. Most of you do, okay? Right now, and in the foreseeable future, certainly for the next 2 to 3 years, we probably, or we might not want to be touching the stocks or the bonds in the portfolio to create the cash flow that you need. All right, those are certainly not a good place to be using cash flow right now, and that may or may not continue into the future. We are preparing for that to be the case, that we might not be able to use those or rely on those for cash flow into the future. But we still have those other 4 investments inside of your portfolio to create the cash flow. So over the next 6 months, the cash flow that you need from the portfolio will come mostly from the little bit of cash that we always maintain in portfolios, plus the dividends and the interest that the portfolio generates on a regular ongoing basis, okay? For those of you that have the structured notes, that dividend and interest is even higher than normal because of the nature of those structured notes. They're churning out about a 7.3% interest rate. And the point of that was to buy us more time that we could rely on just the cash and natural cash flow of the portfolio. However, in about 6 months or so, when those sources have been exhausted or used up and you still need additional cash flow from your portfolio, we have the real estate and the natural resources parts of the portfolio, both which are performing very well. The natural resources is up over 30 to 40%, depending on your holding period, okay? So it's a wonderful source of cash flow for that 4 to 5% that most of you are taking from your portfolios on a regular basis or anticipate taking very soon from your portfolios. We have first the cash, the dividends and interest, then we have those real estate and natural resources investments. Those combined will get us out about 2.5 years. Then for many of you, you'll have your structured notes coming due in December of 2024. You'll get all of the principal back from that, and that cash will be available to continue using to buy us about another 3 years or so after that. So this is about a 5 to 5.5 year plan for creating the cash flow you need, that 4 to 5% you need per year from the portfolio without needing to touch at all the stocks or the bonds, all right? And you can see kind of that order of priority for cash flow there. First, the dividends and interest, and how we carve off pieces for the capital gains. Okay, so what am I watching in the economy right now to figure out whether we stay in a correction and recover from a correction, whether it's going to take longer because we're dropping into a bear market or because we're going into a recession, all right? These are the kind of things that I'm paying laser attention to. The first, I talked about this before, the yield curve, right? The interest rates that short-term, medium-term, and long-term bonds pay, all right, relative to each other, all right? Now, a healthy yield curve is one where shorter term bonds pay a lower interest rate than longer term bonds. So it's an upward sloping line. That is a good, healthy yield curve. That means that bond investors are predicting a very healthy economy, all right? An inverted yield curve, which you see on the bottom right of the slide, is an unhealthy yield curve. That has been an extremely accurate predictor of previous recessions. And little warning light, okay, we did very briefly have an inverted yield curve in late March, early April on a certain part of the yield curve, okay? Specifically, it was the portion between about it was the portion between about 2 years out and 10 years out. So this part of the yield curve, this shorter end of the yield curve became slightly inverted briefly. Okay. Again, that's not like a crystal clear signal that there's a recession coming, but it's something to watch out for. All right. So I'm constantly watching this yield curve to see if that ends up being the case. The other thing I'm watching, business profits. Okay. If businesses maintain profitability or become more profitable, we do not go into a recession. The stock market will recover if businesses can maintain profitability. And what this chart shows you is it shows you the S&P 500 in light blue compared to the earnings, the profits, you can think of it as profits, of the companies inside of the S&P 500, okay? As that line is going up, it's showing you that the profitability of the companies is going up. And this is actually the forward looking, so how companies believe they will be profitable for the next 12 months. Now, if we start to see a drop off in that earnings per share line, that forward earnings per share line, that's a pretty clear indication that most of the companies in the S&P 500 are predicting lower than normal earnings, all right? If business profits drop, we will probably go into a recession. If business profits maintain or go up, we will not go into a recession, all right? So this is the other thing that I'm watching. Yield curve, business profits, and then the third one, the Fed, all right? As I've said before, the Fed swings the biggest stick in this economy. And again, you saw this chart before. This is the size of the Federal Reserve's balance sheet on top, which since before the Great Recession was at about $1 trillion, and today stands at almost $9 trillion. The reason interest rates have spiked up is because the Fed has not only increased short-term interest rates, they've begun doing quantitative tightening, which means they are bringing down the level of their balance sheet. They're trying to sell essentially the bonds in their portfolio, and that is increasing long-term interest rates. So not only are they increasing short-term interest rates, they're increasing long-term interest rates. They do that by sucking money out of the economy at a rate of about $90 billion a month. If they continue doing this while business profits drop, it probably will push us into a recession. However, I believe that if the Fed sees business profits drop and they see the economy slowing down, they will stop quantitative easing, quantitative tightening. Okay, in the news periodicals, it's called the Fed put. All right, the Fed put is the idea that that the Fed will stop the stock market decline by stopping their quantitative tightening. I think that's a little bit, that explanation's a little trite. I think it has much more to do with the fact that the Fed does not want to push us into a recession. And so they're going to be watching things like business earnings, all right, inventories, supply chain, labor markets, things like that. Okay, so we do not predict, we prepare. That being said, I do have an opinion about what I think is going to happen, all right? I do not think we go into a recession. I think we have stable business profits, and I think we see a market recovery within 12 months. However, we are preparing for that not to be the case. I think the Fed continues to raise interest rates, but will pause those interest rate increases later this year if they see business profits start to fall off, all right? I think inflation will slow because, honestly, one of the best cures for inflation is inflation itself, okay? Inflation is too much money chasing too few goods. Well, if prices go up, there's less money to chase those goods. So inflation does tend to be a self-correcting symptom, all right? However, when it gets out of hand, that's when the Fed needs to step in. And I think they're going to see that inflation will be more or less self-correcting, especially as the supply chain improves and the labor market improves. However, there are dangers out there, okay? One is government interference. We do not want higher taxes on businesses right now. That would not be a good thing for your portfolio. Okay, politics aside, that's not what I'm talking about. Okay, for your portfolio, higher business taxes would not be good. All right. We don't want China to fall apart. China's a black box. We never know what's going on in there. But if we start seeing evidence that China's economy is falling apart, that would be a super duper bad thing. And again, a Fed quantitative tightening disaster. The Fed ignores all the signals. They stampede ahead with quantitative tightening. They suck way too much money out of the economy. And then that prevents businesses from being able to invest in growth, and the economy slows down. Those are the three big dangers that I'm watching out for. Okay, so I've kind of told you what our strategies have been the last 4 years, how those strategies relate to what we're doing today. I've told you what I think will happen with the economy and what I'm watching out for and what we're prepared to happen if what I think happens doesn't happen. And I've told you how we'll be managing the portfolios to be sure that you have the cash flow that our projections have showed are safe and a reliable stream of cash flow from your portfolios, so that you don't have to worry about running out of money before the end of your life, right? And I want to reiterate that the stress tests that we do on your portfolios when we go to determine what that safe withdrawal rate is, those stress tests include a 30% drop in the value of your portfolio over a 2-year period. We are not even, we're barely a third of the way through that stress test. Most of your portfolios stand today down about 10 to 11%, okay? So we're not anywhere close to the limits of the stress tests we've put on to say your cash flow is safe and sustainable, which is why I know our cash flow plan will work, because it's well within the bounds of the stress tests that we've done. Okay, I will now go ahead and open it up to any questions you might have. Please go ahead and unmute yourself and ask away.
Jon?
Yes.
Barry here.
Hey, Barry.
When you say you're preparing, but I'm confused a little bit about that terminology. So what is the difference? If you're preparing, are you actually making these moves, or you're thinking about them? What does prepare mean compared to actually changing something?
Sure. So preparation has to be done before the event happens, right? If you're doing something after an event happens, you didn't prepare for it, right? You're simply reacting, right? So all the moves that we made in your portfolio last year, okay, were in preparation for what we're going through today. And it's because of those moves that we now have enough sources of cash flow for the next 5 years without having to touch a single one of the 2 investments that have dropped in value, the bonds and the stocks. So that's what I mean.
So you stay that course then, and if you do, and things, let's say they go further south, you're prepared to make another adjustment?
No, I don't need to make any adjustments for the next 5 years.
Oh, okay.
Which is essentially the limit of the worst recession, the worst recovery we've ever had to wait for. Okay, so we're prepared for the worst, even though we don't think that will be the case.
Got it.
Any other questions?
Jon, it's Rose.
Hey, Rose.
How are you? On just the topic of not predicting, but I'm going to ask you to do it anyway, on just inflation and where you think that I'm seeing definite signs of things starting to flatten out here in Florida in the real estate market. Houses are not going up, they're starting to come down, and it's probably, my guess is it's a reflection of people being nervous about the market, right? Not having the cash on hand to come in and spend twice as much as the house is worth. So the question is just, from all of your knowledge and reading, what is the prediction, I hate to use the word, about inflation and where that's going. Are we in it for the whole year? Any, is the supply chain going to get better? Is it getting better? I mean, there's little signs, it seems, so I'll shut up. Thank you.
Yeah, no. So I don't know what inflation's going to do over the next 6 months. That's too hard to predict because it's too short a period of time. But I do believe that inflation is not going to get worse. Okay, right now we have inflation rates of somewhere between 7 and 8%, and some portion of that inflation is because of supply chain problems and labor market problems. The problem is we don't know what portion is because of supply chain and labor market, essentially COVID-related problems, and what portion is too much money chasing too few goods, okay? Now, the thing about, so I think the supply chain will get better, and I think it is getting better, okay? And I think the labor market shortage will get better, okay? The other part of inflation, I think it's kind of a self-correcting mechanism. Again, you can kind of think of it like, all right, if you're spending more on gas, you have less money to spend on other stuff, okay? So the demand for those other things falls, and that brings down prices, and thus inflation gets better, right? Okay, that's why they say inflation is kind of a self-correcting mechanism, right? So if the Fed gets too aggressive about pulling too much money out of the economy right now, they're going to overcorrect, okay? And they're not stupid. They understand this, right? They released their minutes, well, the summary of their minutes on Wednesday from their last meeting, and though it is absolutely still very hawkish, they're still very aggressive about tackling inflation, it is clear that they are aware of this balance, okay? This is economics 101, and they're way beyond that. And so I think, and again, without knowing exactly what, Chairman Powell and the rest of the Fed board is thinking, that's my bet, is that they pump the brakes on quantitative tightening before they push us into a recession.
Okay, thank you.
Yeah.
Hey, John, it's Greg.
Hey, Greg.
Quick question. As the market goes, have we seen the best days of the lower mortgage rates? Are they behind us?
Yeah, I'm afraid they are. I don't know what's going to happen 10 years from now, but I would bet we've seen the best interest rates for the next 10 years. I think so. But that being said, 5.5%, historically speaking, is still a smoking deal. Okay, but yeah, I do not see the days of 2.5s and 3s and 3.5s coming back.
Got it.
And that's a good thing. That's a good thing. that means we're not going through a crisis, right? That it is unhealthy for an economy to have that low of interest rates for that long of time. Okay. Other questions? Okay, well, we'll go ahead and wrap it up then. As I said, I will be sending out a recording of this video. Please do forward it to anybody in your life who you might feel would need help with some understanding what's going on with their portfolio, or might just be lost and might need some professional help. We are bringing on new clients, and I welcome any of your referrals. And thank you so much to so many of you who have referred us new clients. And then I thank you for all your attention and for attending these meetings, and I hope that they've been valuable. I do appreciate all the feedback that I've been getting on what you want to be seeing in these videos, because I think it's very important, and this is why I'm here, right? It's easy to be a financial planner, a financial advisor when everything's great, okay, and the market just keeps going up. But these are the hard times. This is when what we do is most valuable, and keeping you guys confident and comfortable is my #1 goal, without being rainbows and unicorns either. You know, I want to give you the honest perspective of what's going on and honestly tell you, you guys are going to be okay. All right. Thank you so much, everybody. Appreciate you attending. Take care.
Thank you, John.